Hi, this is Matthew Cratter from Trader University, and today I'd like to talk about three signs of a coming bear market, or if you will, sort of the canary in the coal mine, what I'm seeing right now that shows that the stock market may have already peaked and that we may be due for a bear market. Now, one reason we would want to investigate this is because the stock market has essentially been going sideways since the middle of 2018. You can see 2017, really, 2009, all the way through 2017 was mostly an up market. And ever since then, we've been sort of chopping around, and it's been volatile. We've had some corrections and some very fast snapbacks. But this is kind of a typical topping pattern, or one of a couple kinds of topping patterns. So this is why we might be wanting to look to see if we are about to enter a bear market. The other is that at the end of a bull market, you often get lots and lots of mergers and acquisitions, lots of M&A activity, and that's certainly been true in 2019. We've had recently, just a day ago, it was announced that United Technologies is going to merge with Raytheon. We've had Chevron and Anadarko. We've just had a bunch of M&A activity. So that's the first sign. When you get a lot of that happening, you're usually in the eighth or ninth inning of a bull market. The next indicator is a huge IPO boom, especially an IPO boom that involves lots of big IPOs. So this year, 2019, obviously we've seen Lyft, we've seen Uber, we've seen Beyond Meat, and a bunch of other deals. Very similar, very reminiscent to 99 and 2000. Now, the reason this is significant is because insiders, founders are very much the smart money. And when they decide to go public, they do it at a point at which they think they can maximize their cash raised. And a lot of these IPOs, unfortunately, are sort of the smart money selling to the dumb money. And we've certainly seen a lot of that. We've seen a bunch of failed IPOs this year, Uber and Lyft, which are trading off from where they came out. And then we've also seen just some crazy valuations. We've seen Beyond Meat zoom way up and then crash today. So this is very, very reminiscent. If you lived through late 1999, 2000, you will remember something similar to that. So that would be the second one. Lots of M&A activity, lots of big IPOs, smart money cashing out, selling to the retail investor and the mutual fund, unfortunately. And then the last sort of canary in the coal mine is the U.S. yield curve. So what we have here is we have interest rates on the y-axis. We have time to maturity. These are government bonds, U.S. government bonds, also called treasuries. And you can see a year ago, June 11, 2018, this yellow line, we had a steep yield curve, which means that the 1 month T-bills gave you a lower interest rate than, say, the 10-year or the 30-year. And this is sort of your classic bull market shape, where more time, longer to maturity means a higher interest rate. That's a sign of a healthy economy. It's also a sign that the Fed, that the central bank is still in the process of raising rates. Once you get a inverted yield curve or flat yield curve, as we have today, you can see the red line here. It's inverted up until about the year 3. Then it's fairly flat, and you have inversions. For example, 6 month to 1 year is almost flat or inverted. This is a sign that the Fed is done raising rates. Now, when the Fed starts cutting rates, that is almost never a bullish sign. It's a sign that the economy is weak, that inflation has peaked, that the stock market has peaked. And so a flat or inverted yield curve can be very worrisome as well. So if you take all of these together, and I should mention that the euro-dollar market is pricing in a couple rate cuts this year. They're expecting the Fed to cut rates in September and December, high probability of both of those. Now, the only thing we're not seeing is really kind of a blow-off top, which is what we saw in late 99, early 2000. This is the chart of the NASDAQ composite. You can see that just in about 6 months, the NASDAQ went from 3,000 to above 5,000, just an enormous move for an index. This sort of melt-up straight move. And then proceeded to crash for the next 2 years. We haven't really seen that in this cycle. The retail investor hasn't gotten crazy involved in this sort of stuff. The only thing we have that's anywhere close to that, I would say, was the 2017 sort of straight melt up in all asset classes. But that would be the one thing that would make this piece a little bit different. But the others, the three signs, the IPOs, the M&A, the inverted yield curve, and the market pricing in a Fed rate cut, all suggest that this choppy sideways market is going to resolve itself to the downside. Now, if it does resolve itself to the downside, you're going to want to trade a little bit differently. There are bear market trading strategies that you'll want to use. I'm going to make some more videos about them later this month. In the meantime, if you want to get a sneak preview, you can check out my book on Amazon. I've got a Kindle book, just $2.99, Bear Market Trading Strategies. I've lived through 2 of these bear markets. I've traded them, and there's some really actionable trading strategies in here that you can use. So if you're interested in checking that out, click on the link in the description notes below. And please like this video and subscribe to my channel. And if you have any suggestions for future videos, drop them in the comments below, or any questions. I'd be happy to answer them. Thanks a lot for listening. I'll see you in the next video.